student, welcome to the lecture, Financial Reporting and Regulatory Frameworks, ICB. My name is Ms. Akwenye. My contact details are 081 46 99 338. Let's look at activity number 1 on page 43 in your textbook. You were supposed to calculate the cost of the building as at 1st January 2005. To calculate the cost of the building, we'll say our purchase price is 500,000. We'll add our transfer duties of 50,000. We'll also add our present value of dismantling and removing cost of 22,614. So our cost of initial recognition is at 1st of January 2005 is $572,614. Let's have a look at how we calculated our present value of dismantling and removing cost. To calculate the present value of dismantling and removing cost, we said our estimated future cost for dismantling is 60,000. What is the discount rate? Please see how we have calculated the 0.376. We said 1.05, which is your interest rate, to the power of 20 as the land, as the building has the useful life of 20 years, will give you 0.3769. The present value of dismantling and removing cost is this 22,614. Remember, the 5% was the interest rate and the 20 year was the years of the useful life of the building when we calculated our calculation for the discount rate. Activity number 2 can be found on page 48. You were tasked to pass a journal for the revaluation that occurred. Let's look at the answer. The revaluation deficit should be recognized as an expense to the extent it exceeds any amount previously recognized as a revaluation surplus. Hence, it has been split between the reversal of the previous revaluation surplus and the write-down to other comprehensive income. Your revaluation deficit means if you have an asset or a building and it costs 100,000, that's the cost of the building at the beginning of the year. At the end of the year, you ask someone to come revalue the building, and the person tells you that the land is now only worth 80,000. The meaning that the 100,000 that your land was worth in the beginning, less the 80,000 that it's worth now at the end of the year, the 20,000 difference, that's what we refer to as a revaluation deficit. The opposite can also be said. In the beginning of the year, your land was probably worth 100,000. At the end of the year, you ask someone to come revalue your land and it's worth 200,000. The difference between the 100,000, the value of the land at the beginning of the year, if it was 100,000, less the 200,000 that it's now worth at the end of the year, the 100,000 difference is referred to as your revaluation surplus. The carrying value before 2010 revaluation was 150,000. Your 2010 revaluation value was 75,000. So you have a revaluation deficit of 75,000. Just like I have explained to you. In the beginning of the year, the land was worth 150,000. At the end of the year, someone came in and revalued this property, and they saw that no, instead of it being worth 150,000, it's now only worth 75,000. The difference is referred to as your revaluation deficit, and it's an expense because now our land is less it's worth less than what we had it previously in our books. So it's 75,000 less than the 150 that it was in the beginning of the year. The deficit can be split between reversal of previous revaluation surplus, the 50,000, 150 less the 100,000. Right down to other comprehensive income is 25,000, your 75,000 less your revaluation surplus of 50,000. That's what you write down to the income statement. Let's look at the journal entry, how it will be. You will say debit revaluation surplus in your equity account, 50,000. Then you debit our revaluation deficit of comprehensive income, 25,000. And then obviously our land is going to be decreased with 75,000 as it's not worth 100,000 anymore. 150,000, excuse me. Activity number 3, which is found on page 87. We were supposed to also in this activity calculate the cost of initial recognition in terms of at what price or amount you will put in your purchase price for your asset. The purchase price for the asset is 500,000. Then we less the discounts that we have received because we did not pay for these discounts. Training, staff training cost, we don't include in the cost of the asset. These are excluded. Your testing of the new process will be included as this, because the definition of when you need to calculate the cost of an asset, you say all the costs, the purchase price, the taxes that you pay to bring it in, the cost, the total cost before, up until the point that the asset starts operating as intended. So if we are testing the new process, we are trying to see if the asset is operating as intended. So that's part of our cost price, the 5,000. Operating losses, it's 0. The cost of initial recognition for the asset will thus be 455,000. Thank you and good luck with your exams.